Hi everyone. Uh, so it's our lecture related to capital budgeting, and this topic is the capital budgeting, and it's about the long-term investment. And once we are going for a long-term investment, so how we will be able to select our project? How we'll be able to select the project? There are several selecting techniques. So keep in mind our first lecture, we started our discussion and we started out this subject from the accounting equation. And as we know what is accounting equation, assets are equal to liability plus owners equity. So liability plus owners equity, and we divided the assets in two categories. One is current asset, the other one is fixed assets. So the fixed assets are the real assets which are physically existing and functioning. So for the acquisition of real asset, it means we are going for long-term investment, and in finance language, long-term investment is called capital budgeting. So capital budgeting is one of the major financial decisions of corporate finance. To meet the requirement of capital budgeting means long-term investment, means the acquisition of real assets. The acquisition of real asset is the investment in fixed assets. So to meet its obligation or requirements from its funds, and funds can be generated from the right side of balance sheet, means debt or equity, means debt financing or equity financing, or the mixture of debt and equity. So today this topic is related to the capital budgeting techniques. So for the selection of best project, how many options we have in the market, and if you have several options in the market, then how you will be able to evaluate the project and which is the best option for your investment. So the ultimate objective or basic goal of an investment is the value addition, and how the value can be added with the value can be added with the wealth maximization of the stockholders, and how wealth can be maximized. As we know, if we have the more share price or stock prices more, then wealth will be more. How the stock price can be more if the revenue or income is high, means net income is high. How these revenues are sales can be high if you beat the competition in the market, and you have and keeping the cost low, then we can beat the market. So the objective is how we will be able to select the most appropriate project or most favorable project which gives you the high return on your investment. So we have few techniques. We have this capital budgeting techniques, or we name them the evaluation technique, or we can name them the project selection criteria. So we have several techniques which can be used to select a best project for our long-term investment, and these techniques are normally categorized into these are divided in two categories. There are discounting based techniques and there are non-discounting based techniques. The discounting based techniques are incorporating the time value of money in their formulation, uh, but non-discounting techniques, they normally use they don't use the time value of money in their calculation. So uh, the outline of this topic is what are the basic concepts of capital budgeting, and what are the good decision criteria, what are the characteristics of best decision criteria. We have several techniques, we have several project evaluation methods, we have several measures, like NPV means net present value, internal rate of return, and we have the payback period, we have the accounting payback period, discounted payback period, as well as profitability index or discounted average accounting return. So out of these available options, which technique can be preferred? So we can go for the best decision criteria, and these best decision criteria needs to have to incorporate the basic characteristics in their measurement. So the outline of today's lecture is the basic concepts of capital budgeting and its decision criteria. We will be going to understand the net present value, advantages and its drawbacks. Then we can deal with the computation of internal rate of return, and we can understand what are the weaknesses and what are the strength of IRR. Later, we will be dealing with the payback period and its pros and cons. Then we can discuss the discounted payback period, average accounting return, as well as the profitability index. So we are starting our discussion from the good decision criteria. The best decision criteria needs to have these three characteristics, these 3 points in its formulation and in its calculation. So once we are going to evaluate a project, or once we are going to select a best project for our investment, so we have several techniques. And which technique is considered the best one? The technique which is incorporating these 3 parameters is considered the best technique when reviewing capital budgeting technique rule decision. So we must ask ourselves, either the selected technique is considering these 3 criteria. If the decision rule is considering time value of money, it means there should be time value of money in the selected techniques. There should be risk adjustment. So the decision rule, decision criteria means selected techniques like the project evaluation technique or capital budgeting technique is adjusting the risk factor, or is there proper information of value addition or not. So value addition or not, so we can have the information, so there is a value addition in the technique or not. So we should be very vigilant while we are making the decision. We have to understand either these techniques are incorporating these 3 criteria. What are these 3 criteria? These criteria are there should be time value of money, there should be risk adjustment in the criteria, there should be proper information of value addition or not. Is there information in the decision rule that indicates if we are adding value to the firm or not? So these are the 3 basic characteristics. If these 3 basic characteristics are incorporating in the capital budgeting techniques, which will be preferred. So we have several capital budgeting techniques. We have several decision-making techniques, but which is the best one? So it needs to incorporate time value of money. There should be risk adjustment and proper information of value addition. So we start our discussion from the net present value. So net present value, what is net present value? It is the difference between cash outflow and the present value of cash inflows. So what is outflow? What we are going to invest is outflow. Money is going out from your pocket to the business and you are going for the acquisition. That is outflow. Against our outflow means against on our investment, we receive some money in some future dates, and those are called the future cash flows. So what is NPV? NPV is the difference between outflow, initial cash outflow means your basic investment, and the present value of inflow, what we will be going to receive in some future dates. So what is outflow? The basic investment is outflow. the money we invest for our long-term investment is called outflow. What is inflow? Means what we will be receiving in some future dates is called inflow. So what is NPV? Net present value. So the net present value, that is the difference between cash outflow and the present value of cash inflow. So what are the characteristics of best decision criteria? So the characteristics of best decision criteria are, there are three characteristics. So the criteria, the technique must incorporate the time value of money. There should be risk adjustment, as well as there should be value addition. If we look at this point, net present value, that is a technique which we are using. Just focus on the word. It's the present value, net present value. When we are dealing with the time value of money, there are four factors like present value, future value, interest rate, and time period. So look at the name of technique. It's the present value. If it's present value, so it means we are dealing with the time value of money. If we are dealing with time value of money, there is interest rate, there is discount rate, there is rate of return, there is discount rate, or we can name it exchange rate. So the interest rate is normally used, or discount rate, or that interest rate or rate of return is normally used as a measure of is used against the risk which is associated with that investment. So if there is time value of money, obviously there is adjustment of risk factors. So the third point is, it will give us the clear picture, either our outflow is more or inflow, present value inflow is more. If we have positive NPV, it means there is value addition. If there is negative NPV, it means we are going for loss. So negative means outflow is more, your inflows are less. It means if there is no value addition, so that project is not favorable. If we are getting the present value of inflow is greater than the outflow, initial cash outflow means our basic investment, then we have the positive answer. So positive NPV means we have value addition. So this criteria, in sum up, with one sentence, this criteria is incorporating all three characteristics of best decision criteria, which are, there should be adjustment of time value of money, there should be risk adjustment, and there should be proper information of value addition of the project. So what is the rule, a decision rule? So in this case, if NPV is positive, we accept the project. Otherwise, we reject the project. Already I have explained. A positive NPV means there is value addition, indicates that project is likely to add the value to the business and which can improve the wealth of the owners. And this is the basic goal, and it's the prime goal of the owners: wealth maximization, value addition. Value addition is based on wealth maximization. So if there is a positive value, positive NPV, it means there is a value addition, means our present value of cash inflow is higher than the cash outflow. Because our aim is to grow owners' wealth, and NPV is a clear measure of how successfully this project will do that. So it means it's giving us the clear information how the value is going to be added. So here we have example. We consider this example, and for example, we have a new project, and having estimate which are having the following cash flows. So at zero means today what I am going to invest. If look at the sign, that minus doesn't mean the value is minus. This minus 165, this indicates that the money is going out. That is basic investment. At the end of first time period, how much we are getting? We are getting 63,120. At the end of second year, we are getting 70,800. In third year, we are getting 91,080. At the rate of return, risk rate is level of risk is 12% in this project. So in this option, our basic investment is 165,000, and our what we will be receiving in 3 years. First year we are receiving 63,000, second year 70,000, third year we are getting 90,000 something amount at the rate of 12%. Then we need to make the comparison, either our outflow or present value of inflow is more. So if the positive answer, it means there is a value addition, then we accept the project. Otherwise, we may reject the projects. Here is the calculation, very simple formula, already I explained. So minus 165, 100,000. So plus 63, we are going to discount, means present value of each cash flow, present value of each cash flow. At the end of, means in first year, we will be receiving, it means that is the first cash flow or future value divided by 1 plus I raised power 1. So second year value is 70,800 divided by 1 point I raised power 1.12 raised power 2. Third cash flow is 91,080 divided by 12, 1.12 raised power 3. So in this case, after simplifying the, after here is the cash outflow, means basic investment 165,000. So here we have the present value of each cash flow. After simplifying, we have 12,627. That is the overall sum of value, and its positive value, which indicates there is a value addition. Our outflow is less than the present value of future cash inflow. So we accept the project. This project is giving us some value addition. This project is helping to wealth maximization of the earners. So what is decision? Do we accept the project or reject? If it's the positive value, we accept the project. Otherwise, we reject the project. So this was the one example which we can use to make how we calculate the net present value, NPV, and how we can make decision, and how we can utilize the concept of time value of money. So here we have another example. You can go through by yourself. The basic investment is 135,000, and at first cash flow we have 62,000. Second year cash flow is 30,104, and third year is 40,000 something. And we have the level of risk, means the rate of return, interest rate is 10%. So we can find the value. If the answer is positive, then we can accept the project. Otherwise, we reject the project. So later we have the second criteria, internal rate of return. So internal rate of return, here we need to determine the rate of return based on the cash flows which we will be receiving in some future dates. So based on those cash flows, we can determine the internal rate of return, means actual rate of return, which can be calculated from the future cash flows. So NPV, IRR. So if we are going to find the internal rate of return, we are going to determine the rate of return, interest rate, discount rate. It means we are dealing with time value of money. 4 components of time value of money: present value, future value, interest rate, and the number of time periods. So we are going to find the rate of return. So if we are determining the rate of return, so it means we are dealing with the time value of money. So what are the best characteristics of good decision? What are the characteristics of best decision criteria? 3 characteristics. It incorporates time value of money. The decision rule must adjust the risk factor, and there should be a value addition. So time value of money is in this criteria, because we are dealing with the interest rate. We need to find the interest rate. So that is, interest rate is the real rate which we can determine based on the given cash inflows. So IRR, we can define the IRR. What is IRR? The rate where NPV is equal to 0. What is definition of IRR? The rate where NPV is equal to 0. When NPV can be equal to 0, if outflow is equal to the present value of cash inflows. It means the present value of cash inflow is equal to outflow, then NPV will be 0. So what is IRR? IRR is the rate where NPV is equal to 0. So how we can find? So we have the equation. We need to find cash outflow is equal to the present value of cash inflow. So if they are equal, then NPV is 0. If NPV is 0, then we can name it the rate which equates NPV 0. Then we can say that is the IRR. So the internal rate of return for investment proposal equates present value of future cash inflows with the initial cash outflow. The present value of cash inflow is equal to the cash outflow. Then we can say that is the rate. That rate is called IRR. So in simple words, the rate which give the NPV equal to 0 is called IRR. So we define IRR and how we can make decision of IRR. Definition is IRR is the rate that makes NPV 0. So how we can accept the project or reject the project? If the IRR is greater than the some required rate of return which will be given on that project. So if the IRR is totally based on it's the calculation based on cash inflows. If the IRR is greater than the required rate of return, then we accept the project. Otherwise, we reject the project. It should be how we can calculate. So three components. What is definition? Then what is decision? And what is the method? So definition, the rate where NPV is equal to 0 is called an IRR. What is decision? Decision is if IRR is greater than required rate of return, we accept the project. Otherwise, we reject the project. So how we calculate? So we calculate it trial and error method, or we can name it hit and trial method. So and this method is having its mechanism. So we will follow this mechanism from the next slide. It should be calculated by trial and error process, or we can name it hit and trial method. If IRR is greater than required rate of return, then we accept the project. Otherwise, we reject the project. So for the trial and error method, what we need to do? So it's very simple. Within 2 steps, within 2 calculations, we can, or 2 or maximum 3 calculations, we can find the exact rate. So trial and error, just focus on the word. What is the name of method? Trial and error. Just try. Try for what? Find the present value of an assumed rate. Present value of cash inflows at assumed rate. And compare with the cash outflow. If both are equal, then that rate is called IRR. So trial and error, there might be, if you assume a rate, and you need to find the present value of cash inflows. So it may or may not give you the equal value related to cash outflows. So in this case, find the interest rate, internal rate of return. Then we can trial and error method, and we can calculation via interpolation method. So find the interest rate. We need to find the rate of return. Sorry, not rate of return, internal rate of return, which discounted cash flows to equal to 100,000. It means, so our basic investment is 100,000. If the required rate of return is 15%, do we accept the project or reject the project? So the required rate of return is given, but we need to find the internal rate of return of given cash flows, means the cash flow we will be receiving in some future dates. So we are going to invest 100,000. At the in first year we will be getting 34,400 something. In second year we'll be getting 39,500 something. In third year we'll be getting 39,300 something, and the fourth year cash flow is 32,219. So what we need to find? We need to find this rate. This is the rate which is called internal rate of return. It's the rate which we are going to calculate based on future cash flows. Then if this rate will be compared with the required rate of return, which is 15%. If this rate IRR is greater than 15%, then we accept the project. Otherwise, we reject the project. So what is IRR? So we assume a rate, then we find the present value of cash inflows. If the present value of cash inflow is equal to the cash outflow, which means NPV is 0. So the best thing is, when we are going for the trial and error method or into flotation method, so we normally have the required rate of return. First of all, you have to find the value at required rate. So we can find the present value at required rate of return. So in next slide, here we assume we find the cash flows at required rate of return, which is 15%. So I suggest you can, because here we have all values are different to each other. So we need to solve piece at a time. If we have the same values each year, each cash flow, then we can find the group at a time. So in this case, we have to find the present value of this. What rate we assume in this case? We assume 15% required rate of return. So 1 plus means 1.15 raised power 39,000 divided by 1.15 raised power 2, and so on. You can simply put the values and simplify in this equation, or either you can go for this tabular form. This is called the interest factor form. So we have each year cash flow, first year cash flow, what we will be receiving. So we need to find present value of this cash flow, which we will be receiving in some future date, means in 1 year. So what's its value today? Present value is called today value. Future value is called later value, means in after some time period. So first cash flow is 34,432, and the rate of return which we assume in this calculation is 15%. So what is the assumed rate? Always the first assumed rate, whatever you wanna you have as a required rate of return, find the present value at same rate. So at the rate of 15%, if you have table number 2, I have already provided the time value of money tables. So go to the table 2. Table 2 is related to present value interest factor. Go to the 15%. Go to 15%. Then 1 year. So the 15% 1 year present value interest factor 15% at 1 year is 0.87. So number of, as we know, more the number of time period, less will be the present value. As we know, higher is the rate of return, means higher is the interest rate, less will be the present value. That's why there is inverse relationship between present value, interest rate, and time period. So it means, so present value will be low due to increase in the interest rate or time period. So first time period T is 1, cash present value interest factor is 0.87, 0. If time is increased, then the present value interest factor is going to decrease. Second year time is increased. Third year time is increased. The present value interest factor is going to decrease. Fourth year time is increased. The present value interest factor is going to decrease. That is the overall logic what we have discussed. Due to increase in time, the present value interest factor is going to be decreased. So we can find the present value at first year. What we will receive? We will receive 34,432 in 1 year at the rate of 15%. Its present value is 29,955. So we better know always present value is less than the future value. So today value of first cash flow is 29,055.84, and it's after 1 year its value is 34,432. It means we will be receiving at the end of 1 year 34,432, or in 1 year for 34,432. What its value today? Its value at 15% is 29,955, and so on. We can find for the second one, we can find the third year cash flow, we can find the fourth year cash flow. At the sum, if we are going to take the sum of all cash inflows present value, it's equal to 104,168.01. So 104,168.01. So this is the present value of cash inflows at 15%. What we are required, this value should be equal to 100,000. If it's equal to 100,000, then we can say both inflow means outflow and present value of inflows are equal. If they are equal, then we can say NPV is 0. If NPV is 0, that rate is called IRR. So at 15%, we have bigger value. What we need 100,000. So this is what we name it trial and error method. We assume a rate and we find the value. It's not what we are required, but it's bigger than our required value. Here is a decision. You should be very vigilant while this point. What is first point? Calculate the present value of all future cash inflows. If that present value is greater than the initial cost investment, means initial cash investment, means initial investment. I repeat. So first step, calculate the present value of all cash inflows at required rate of it. It may be greater than the outflow, it may be equal than the outflow, or it may be less than the outflow. So what we do, if it's equal, then it means that is the rate that can be the required, that can be the internal rate. If it's more, then what you need to do? We go for the another assuming rate. So the second assumed rate should be more than the first assumed rate or less than first assumed rate. What we need here? 100,000. What we find? 104,168. It means we have more value. Present value is bigger at 15% as compared to 100,000. We need less value. So 104 is greater than 100,000. We need to bring towards 100,000. We need 100,000. We need less value. So keep in mind how we can have the less value. What is relationship between present value and interest rate? The relationship between present value and interest rate is inverse relation. Higher the interest rate, lower will be present value. Lower will be present. If we increase the interest rate, then less will be present value. In this case, what we have 104. What we need 1,000, 100,000. So if we need lower present value, so the next assumed rate should be greater than the required rate of it. Should be greater than the required rate. If we get this value, for example, this value 90,000. 90,000. So if I'm taking the example, if this value is 90,000. So what we need, for example, we need 100,000. We need more value. So how we can get the more present value? By decreasing the rate of it. So there is inverse relationship between rate of return and present value. If we need less value, we need to increase the rate of it. If we have more value means larger value, we have to decrease the rate of return. We are dealing with present value. So in this case, at 15%, what is 15%? That is the required rate of return. So which is required rate of return, the present value is greater than the outflow, initial outflow. So we need more rate, which may equate present value, which may equate the present value of cash inflow and cash outflow. That is our objective. Our objective is to find the value, find the rate where NPV means outflow is equal to the present value of cash inflow. So we are very sure the next assumed rate should be greater than 15%. Why greater? Because we need 100,000. If we increase the rate, it will be decreased. So the next rate should be more than 15%. I assume, for example, why that method is called trial and error method. Try, find the value. There are chances of error, so then go for the retry yourself. So for retrying, so we need to be very, very careful, very vigilant. Either the next assumed rate should be more than the first assumed rate or less assumed rate. Less than the first rate means required rate of it. One rule of thumb is if you have bigger value, larger value, then the outflow, the next assumed rate should be greater than the required rate of it. If you are getting the less means smaller value than the cash outflow, then the next assumed rate should be less than the required rate of return. We are sure. So our internal rate of return should be more than 15%. So I assume 20% is the required rate of return. So I calculate the value at 20%. So 20% is the next assumed rate, which is greater than the 15%. And if I am taking 20%, so obviously I will be getting smaller value. So again, you have time value of money table. Go to the time value of money table, 20%. At 1 year, we are getting 0.83. Then second year, the interest factor is going to decrease. And fourth year, we are getting 0.48. Then we have the same cash inflows. We can multiply these cash inflows with the present value interest factor at 20%. Okay, so we are getting these values because interest rate is increased, time factor, the present value interest factor will be decreased. So we are getting the smaller value. After simplifying, we have 94,434.1. What we need? We are required 100,000. We are required 100,000. 100 is our outflow. And what we need, our inflows present value should be 100,000. At 20%, it's 94. At 15%, it's 104 something. So it means 100,000 is in between 94,000 something and 104,168. 100,000 is in between 104 and 94. So we are sure our internal rate of return should be between 15% and 20%. So the next step will give you the exact value. The next step we can use, it may give us the exact value. So how we can write at 15%, what is present value? 104,168. What we need the rate? We need the rate which give us the value equal to 100,000. So at 100,000, we need to find a rate, and this rate is called IRR. This rate is called IRR. So at 20%, if the rate of return is 20%, then we find 94,434 point this way. So I repeat, 15% present value is 104. 20% present value is 94.43. We need to find IRR. We need to find IRR. So at what is IRR? Where the value should be equal to outflow. Where the present value should be equal to outflow. So here, in these two, we need to find IRR. We can denote it X. We can denote it X. 15% and IRR, we need to find IRR. It may be considered X. So the difference between 15% and 20%, 15% and 20% is 0.50, 0.05. Means 15% and 20% difference is 5%, and 5% is 0.05. So here we can have the difference between present value means 15%. The difference between 15% and IRR means 100,000. The difference is 4,168.01. The difference between 15% present value and 20% present value is 9,733.91, and these values we calculated in last two slides. So how we can write? So this is X, this side, X divided by 0.05, X divided by 0.05. And this side, how we can write this side? The difference between 15% and present value of IRR. So we can find that is the 4,168 divided by the difference between the present value of 15% and 20%, that is 9,733.91. So after simplifying, this is the equal sign. After simplifying, we are getting the value of X. So if we need to find X, we can multiply 0.05 in the numerator, means 4,168. So this 0.05 is going to be multiplied divided by this. After simplifying, we have the value 0.0214. So we can find IRR. How we can find IRR? I lower. What is lower I, which we have? Either 20% or 15%. So 15% is the lower rate, lower assumed rate. 20% is the upper assumed rate, means higher assumed rate. So what is IRR? Lower assumed rate plus X. So the lower assumed rate in this case is 15%, and the X is 0.0214. After simplifying, we are having 17.14%. We are having 17.14%. So 17.14% is between 15% and 20%. 15% and 20%. So in this case, 17.14 is the internal rate of it. So what is decision? How we take decision? Accept the project if IRR is greater than the required rate of return. So the required return. So in this example, the required rate is 15%, and IRR, which we find, is 17.14%. So we accept the project. So in this case, it's higher than the 15%. what is 15%? It's the required rate of return. So it's greater. So we accept the project. For example, if this rate is 13.14%, so if IRR is less than the required rate, we reject the project. Otherwise, we accept the project. So if we calculate this rate with Excel or calculator, time value of money calculator, there is no effect of rounding. So approximately we'll be getting the exact rate, exact yield rate is 17.04%. That is the exact rate. And this is almost 17.14, 17.04, more or less same. And the nominal difference is existing. This nominal difference is due to the effect of rounding. So this is the method to find the IRR. And NPV is suggesting we accept the project. That was the different cash flows. Here we are having different cash flows. So we are our internal rate of return is also greater than the required rate of return. We can accept the project, or we can use this expression, means lower assumed rate plus present value of lower assumed rate minus present value of IRR. What is the present value of lower assumed rate? Lower assumed rate is 15%. Present value at lower assumed rate is 104 something. Present value of IRR is 100,000 divided by present value of lower is 104 something. Present value of higher means 20% is 94,000. Whole multiply by I means higher assumed rate, which is 20%, and lower assumed rate is 15%. So these are the expressions. Same, we can simplify. So the lower assumed rate is 15%. The difference between these two is 4,168. The same what we did in the last slide. The difference between these two is 9,733. The difference between higher and lower assumed rate is 5%. So after simplifying, this is going to be, after dividing this, we can multiply these two expressions. So we are getting 17.14%. So the same approach you can use. This was about internal rate of return. Once we are going to find the internal rate of return, we can use this approach. So we have done with net present value. Net present value incorporates time value of money. It incorporates the risk adjustment. There is the risk adjustment, and it also gives the proper value addition, the proper information of value addition or not. So the IRR is more close to NPV, and it's giving us the it's incorporating the time value of money, and there is the risk adjustment, and we determine the internal rate of return. So this is the question which you can solve for yourself. And here we have 2 years cash flow, 50,000 for first year and 15,000 for third year, and first year cash flow is 28,000, and basic investment 8,000, and the required rate of return is 12%. You need to find by following the same approach. If your IRR is greater than this 12%, then we accept the project, otherwise reject the project. So what will be the mechanism? At first stance, you find the present value of these cash flows at 12%. Present value of these cash flows at 12%. If you have the present value more than 80,000, then the next assumed rate should be more than 12%. If your present value at 12% is less than 80,000, then you need to decrease the rate. If you decrease the rate, present value will increase. Already explained in detail. So what is the difference between IRR and NPV? And either they go hand in hand, or either they give the different results, or different biased results, or opposite results. So as we know, IRR and NPV give us the same results, but IRR results are biased in two assumptions, in two situations, two scenarios. So NPV, IRR generally give us the same decisions. For example, what same decision if NPV is accepting, IRR is accepting. If NPV is rejecting a project, then IRR will also reject that project. So, but two conditions, IRR and NPV, give us the different results, means may give us the biased results, may give us the opposite results. Then we have to, if there is a match between IRR and NPV, we follow NPV. Or we can say if there is a match or conflict between NPV and any other criteria, between NPV and any other criteria, then always we prefer NPV. So here we have the two conditions where we can get the different results. IRR give NPV and IRR may give us the different results. So two exceptions are if there are non-conventional cash flows or if there are mutually exclusive projects, then the IRR and NPV will give us different results. So in this case, the non-conventional cash flows, what are the non-conventional cash flows? If the signs of cash flows are being changed more than one time throughout this stream of cash flows. For example, one time positive value, other time negative value, then positive, then next cash flow may be negative. So it means if we have the mixture of positive cash flows, mixture of positive and negative cash flows on the timeline is the from the project. So that is called non-conventional cash flows, which is called non-conventional cash flows. Mutually exclusive project, it means they are different in their nature. So they are totally different. Initial investment are substantially different. So the timing of cash flow is also different. So for example, their manufacturing industry is having its own own mechanism. So it's the working. It has its own characteristics. Service industry is different from the manufacturing industry. They work in different ways. So they may be mutually exclusive. Or we can say mutually, if you select one, you can't select the other. So that is called mutually exclusive project. So in sum up of this slide, NPV, IRR normally give us the same results, but in two situations, two conditions, two exceptions, IRR may give us the biased results. And these conditions are non-conventional cash flows and mutually exclusive projects. So when the cash flows, this is the IRR and non-conventional cash flows discussion. When the cash flows signs are changing more than one time, that is called non-conventional cash flows. Then we will be having more than one IRR. If we are having different, if the signs of cash inflows are getting more than one time, then we will be having more than one IRR. So when we solve for IRR, you are solving for root of the equation. When you cross the x-axis more than one time, it means we are having more than one IRR. If we are having more than one IRR, which you rely and which you don't rely, which you accept, which IRR you prefer, which IRR you are not prefer. So then what's your decision? So there is the confusion. There might be chances of misleading the decision rule. So in this case, we have an example. Your basic investment is 90,000 initially, and what we are receiving 132 in first year to 100,000 in second year, and in third year we are receiving the cash flow is negative. First 2 years the cash flow is positive, and the third year cash flow is negative, and the required rate of return is 15%. Either we accept the project or reject the project. So the cash flows are suggesting these are the non-conventional cash flows. What are the non-conventional cash flows? That is the mix of positive and negative cash flow. So it's leading to non-conventional cash flows. So will be getting more than one IRR. We'll be getting more than one IRR. Then what IRR we can believe or what we can't rely. So here we can find the NPV of this project. So if the basic investment is 90,000 and present value of first cash flow, present value of second cash flow, then the present value of third cash flow. NPV after finding the NPV is a positive value 1769 on this project. So NPV is recommending we can accept this project for the calculation. So here we have the we have cash flows. Here we can find the we can find these values from the calculator and so on. If you compute IRR on the calculator, it may be 10.11%. It may be 10.11% because it is the first one you come to, and so NPV would say, so it's if we go for the computation of an IRR through calculator or through Excel file, the IRR is 10.11%. NPV by using these cash flows at 15% is 1769.59. So the NPV is suggesting accept the project, and the IRR is 10.11, which is less than the required rate of return. So the IRR criteria is recommending or suggesting we need to reject this project because IRR is less than the required rate of return. So there is a match. So there is a match. NPV is suggesting accept the project, and IRR is recommending reject the project. Okay, so which criteria we need to follow? We as I have explained, if there is a mismatch, if there is a conflict between this IRR and NPV or any other criteria, we prefer NPV. So NPV is recommending accept the project, IRR is recommending reject the project. So we rely on IRR. So if we look at this point, so this point is for the positive, this is the NPV is 0. Here are the positive NPV, here are the negative NPV. So here positive, what is IRR? Where NPV is equal to 0. So in this graph, we can have a better look. So in this graph is telling us it's crossing the, this is about the non-conventional cash flows. So for positive, so it's crossing here. So it's some extent 10.11%. 10.11%. If we look at its crossing here, that's almost 42 or 43%, 43% something. So here the IRR is crossing this at this 43 point something, NPV is 0. So this 43 is recommending accept the project. Here 10.11 is recommending reject the project because the required rate of return in this example is 15%. If IRR at this point, IRR is less than 15%, means required rate of return. This point is recommending reject the project, and 43% is greater than 15%. So it's recommending we have to accept the project. So non-conventional cash flow, why you reject this one? Why you adopt this one? So there is a difference between if we have non-conventional cash flows, we can have more than one IRR. If we have more than one IRR, we need to find single IRR. So how we can find the single IRR? Then we have the modified IRR technique. How we can find the modified IRR? That is something different. So I will not go in detail of modified IRR. So we need to understand the concept. So IRR, what is IRR? Where NPV is equal to 0, and IRR give you the misleading results in two situations. First situation is non-conventional cash flows. What are the non-conventional cash flows? When we have a mix of positive and negative values of cash inflows. So if we have a mix of positive and negative cash inflows, then we will be having more than one IRR. So more than one IRR, which is correct, which is not correct, and they will give us the different decisions. So we will not rely IRR if we have the non-conventional cash flows, then we follow the DCNR value, which is given, which is calculated by NPV. So the summary of the DCN rule of non-conventional cash flows, the NPV is positive at required rate of return is 15%, so we accept the project. So you want get IRR 10.11%, which suggesting reject the project. So we need to recognize that there are non-conventional cash flows and look at NPV profile. That is the best decision criteria. So the other is mutually exclusive project. It means if we choose one and we can't choose the other one, we have, for example, different schools. Examples may be given. For example, Harvard Business School, if you want to select Harvard, but you can't select Stanford. If you select A, you can't select B. So they may be mutually exclusive projects. So you would use the following decision rule. So NPV, higher the NPV, that will be preferred. Higher the IRR, that will be preferred. So two criteria, what we need to follow the NPV. So here we have two projects, for example, at the rate of 10%, the basic investment is 500 for project A, for 400 for project B. First year cash flow, second year cash flows, these are given. If we find the IRR of project A, it's 19.43, and for project B, 22.17. NPV of project is 64.03 and 60.74 is the NPV of project 2. So if we look at the decision rule, IRR, higher the IRR, more is the preference. Project B is having higher IRR. So the IRR criteria, if we follow the IRR criteria, it's just in go for the project B. If we look at the NPV decision criteria, it's project A is giving us 64, project B is giving us 60.74. So NPV bigger the NPV, larger the NPV, more will be preferred. So NPV is recommending go for project A. IR is recommending select the project B. So which we have to select. So if there is a match, non-conventional cash flow, if there are mutually exclusive projects, we follow the rule, we follow NPV. So in these two projects which we will be selecting, we'll be considering project A because it's giving more, it's giving larger NPV as compared to project B. So what is our objective? Value addition. What is the objective of investment? Wealth maximization. So the wealth is more in the project A as compared to project B. So that is the purpose of NPV, and to find the positive value for the purpose of the investment, and it's the basic goal of the investors, wealth maximization. So here is the graph. So project A is a blue line and is a red line. Project B is having the blue line. So this is the NPV 0. If we look at project A, it's intersecting. It's about, if we look at it's 15%, it's about maybe 19 point something, maybe 19 point something, 19.43% project A. So project B is intersecting the 0 line where NPV is equal to 0. It's about 22.17%. If we look at here, we have the on y-axis, we have NPV. On y-axis, if for project A, the project for project A, that is the red line, it's almost 158 something or some about 160 or 150, sorry, 150. So it has the more NPV, means larger NPV, and project B is having the smaller NPV. So project A is preferred based on the NPV, but if we look at IRR, it's recommending go for project B because here its rate of return is 22.17. So what can be the modified IRR? So modified IRR, the rate 11.8% is the rate where both lines intersect to each other. So at that point we can find that is the 11.8%. So we can draw the curve here. So 11 where they intersect, these two curves are intersecting to each other. At the intersecting point, the rate is 11.8%, which may be the rate of return on this part. So uh, you can have a practice of mutually exclusive project. The required rate of return is 15%, and you can find IRR, you can find the NPV, and then make the decision. Now we have, if there is a conflict between IRR and NPV, so the NPV is a direct measure of value addition. If there is a conflict, if there is a match between NPV and other decision criteria, we always prefer NPV. So IRR is giving the biased results, is providing the unreliable results in two situations. What are those two situations? One is if we have non-conventional cash flows, we can have IRR will mislead us. If we have the mutually exclusive projects, we can have the different values. IRR will be biased. So the next criteria is the payback period. So the payback period, just focus on the word payback, how long it will take to retrieve back my money, my basic investment. So payback period, what is its concept? How much time it will take to get back my money means your investment. So the basic investment, how much you will be taking time to receive back, to retrieve back, to get back your basic investment at nominal sense, in a nominal sense. So how we can compute the decision? So the definition is how long it will take to get back my money. Means your basic investment. How we can compute? So simple is that cash outflow minus cash inflow. Cash outflow minus first time period cash inflow. First, how to find the second time period? Remaining value means the difference between outflow and cash inflow first time period. That value will be used for the next time period. That value, the difference of first time period, the answer of first time period minus cash flow of second time period. Then the same for the third time period, fourth time period, and so on. So subtract future cash flows means future cash flows means cash inflows from the initial cost until you receive back your money. So the initial investment has not been recovered. So how much time it will take to receive back your money in a nominal sense. What is a decision rule? So this rule now, it needs an arbitrary cutoff point. For example, I want to get back my money in 2 years. This is arbitrary cutoff point. It may be if the project is having 5 years life. So for example, if I need to find I need to have the future cash flows, I need to have cash inflows for 5 years. So if I want to retrieve back my money in 3 years. That is arbitrary cutoff point, arbitrary point. So this arbitrary point needs to be very clear, very carefully identified. So nominally, there should be a logic, there should be it should be making sense once we are going to have the arbitrary cutoff point. So subtract the future cash flows from the initial cost until your initial investment is not required. So what is DCN? Accept the payback period, accept the project if you are getting back your money within the arbitrary cutoff point. So accept if the payback period is less than some present limit. What is present limit? Means arbitrary point. So we accept the project if we receive, if we get back our money within given time period. So payback period, assume we will accept a project if it pays, if it pays back in 2 years. Arbitrary point is 2 years, the basic investment, whatever you have. So first year, so this is the example which we have discussed for NPV. So the basic investment was 165. Basic investment is 165. At first cash flow, we are receiving 63,000. Second cash flow, we are getting, we will be getting 70,000. And third cash flow will give us 91,000 and something. So do we accept the project or reject? So here is the solution of payback period. The basic investment is 165,000. So you're not supposed to be confused yourself why negative sign is not here. That negative sign was just to give you the sense that is the investment, that is the cash outflow, but the value is not negative. That is just for understanding that is outflow or inflow. At 0 time period, whenever we are making the payment at 0 time period, is considered the cash outflow. So in this case, our cash outflow is what we are going to invest is our initial investment is 165,000 minus first year cash flow 63,120. So at the end of first year, I still have to receive, I still to recover 101,880. So the second year, for second year, how much left? 101,880 minus second year cash inflow. After 2 years, still I have to recover 31,080. Still it needs to be recovered. So what was your cutoff point if the project, I select the project, if my money is getting back in 2 years. So in this case, money is not, still 31,080 is to be recovered, So for third year, so 31,000 minus 9. So it means, even how much you have to recover? 31,000 almost. And how much you have to receive in third year? 91,000. So this is 91,000. You will be rejecting this project. Even you will be getting more money in next year, but your arbitrary point is, payback period point is 2 years. So you are not getting your money in 2 years. It means this criteria is suggesting you reject the project because it's not recovered within 2 years. Means in the arbitrary cutoff point, what is arbitrary point? In this example is 2 years. In 2 years, still we have to recover 31,080. So payback period is 3 years. The payback period is 3 years if you assume that the cash flows occur at the end of each year. Then we do with all of the other decisions. So if we assume that the cash flow occurs eventually throughout this year, so the properly project pays back in 2.34 years. So how we can find the total payback period, how much time it will take? Outflow divided by the value of outflow divided by this value. So we can find the present value of, we can find the payback period. So in this case, will be it's not been recovered in 2 years. It needs to recover. So it's taking 2.34 years instead of 2 years. So we will reject this project. So either way, the payback rule would say to reject the project. So if we assume that cash flow occur evenly throughout the year, then the project pays back in 2.34 years. So our it's going to pay 2.34 years, but our arbitrary point is 2 years. So we reject this project. We are still to recover our money. So in this case, what are the criteria of best decision criteria or best decision technique? So there are three criteria. If these three criteria are incorporated in the technique or decision rule, is considered the best decision technique. Time value of money? No, there is no time value. No time value of money. If no time value of money, there is no rate of return, no interest rate, which is the risk adjustment. And it's this criteria is not giving us any information related to value addition or not. So the best decision criteria needs to cover the three components. So here you can go through by yourself. The basic investment is 70,000 and first year cash flow is 39,000. 70,000 minus 39,000. What is your criteria? Arbitrary point is two years. So you want to retrieve back your money in 2 years. So then we accept the project. Otherwise, we reject the project. So in this case, your 70,000 minus 39, so still you left to retrieve back your money 31,000. But the second year you have 37,000, so it means your money is retrieved back, your money is recovered in 2 years. So we accept the project. So this is the way you can calculate you can use the payback period. Keep in mind the definition and calculation method. So in this example, it's not adjusting time value of money. So what can be the advantages and disadvantages? Easy to understand. So it adjusts the uncertainty of later cash flows. So already you have recovered your money at first year. So you are not left with the whole amount. Already you have retrieved back this proportion of your money. Then second year, you already retrieved back your money, almost 80% of your money or 85% of your money in 2 years. You left with less money. It means there is less future risk on the remaining amount. So you are receiving back your money. It means you are having the less future risky inflows. So this is the having adjust for the uncertainty of later cash flows. It has several problems, means cons. So it ignores time value of money and it needs arbitrary cutoff point. But how this arbitrary cutoff point is fixed, how it's why 2 years, why not 3 years? What are the mechanism? What is the sense? What is the logic? How this arbitrary point is determined? This is the big challenge. Ignores cash flows beyond the cutoff date. As we have example, it ignores it. It needs to receive back 31,000, but the next cash flow is giving 91,000, and next it's ignoring. So it ignores the cash flow beyond the cutoff date. So it's biased against the long-term projects, or for example, long-term projects, they can be the research and development projects, these can be the new projects, developing new products, and so on. So this and payback period is give the biased results. It's biased towards the liquidity. So because every time period is giving you the cash flow, so it's normally biased towards the liquidity. So to overcome the problem of time value of money, then the next one is discounted payback period. To overcome the problem of time value of money, then the cash flows are discounted. It means here we normally find the present value of cash inflows, then the present value of cash inflows will be subtracted from the cash outflow. Each year cash outflow minus first year present value of cash inflow, whatever we have, then the same value will be the same value minus second year present value, second year cash inflow present value. The method is same, but one thing is different. Here the cash flows are first the cash flows are discounted, means their present value are present values are determined, then those values are subtracted from the cash flow, cash outflow. We have this same mechanism as we have for the payback period. Just difference is it's incorporating time value of money, and it needs arbitrary point. It also ignores the uh, cash flows beyond the arbitrary point, and there are several pros and cons. So compute the present value of each cash flow, then determine how long it will take to receive back your money. Okay, receive back your money on a discounted basis. What is discounted basis? Means the cash flows which are, means future cash flows which you will be receiving, which are related with the project and to be received in some future dates, needs to be discounted, means needs to be find their present value. So there we have to find their present value. So compared to a specified required, means arbitrary point, required date. So how many years you want to, in how much time you want to receive back your money. So what will be the rule of thumb? So what will be the arbitrary point? So the decision criteria, if we are getting back our money, means our basic investment within arbitrary cutoff point, we accept the project. Otherwise, we reject the project. So we have same example, 165, and the first year cash flow is 63,120, and it's going to be and the rate of return is given in this example. The required rate of return is 12%. So from start, we have the same example. The rate of return is 12%. So at 12%, so first we find the present value of first cash flow, then this value will be subtracted from the basic investment, means cash outflow. We left with 108. If we find the present value of 63, we are getting less values. So obviously we left with more money to receive back. So this 108,643 will be used for next year. So this is used for next year. Then we have the next year cash. We have the next year cash inflow. It will be discounted at 1.12 raised power 2. So still we have to receive 52,202. So these are the arbitrary point is 2 years, but we didn't receive back our money in 2 years. After 2 years, still 52,200 is to be received. So this is recommending our money is not yet received. So we will be going to reject this project. So in this case, for the third time, if the arbitrary point is 3 years, then this project you can accept this project. Otherwise, it's going to be rejected. So the same cash flows, NPV is accepting, but payback period is rejecting, and discounting payback period is also rejecting. So there is a clear mismatch between these two. There's a match between NPV and payback period as well as discounted payback period. So we prefer NPV. So what are the pros and cons? So it includes time value of money and easy to understand. It does not accept negative estimated NPV. So it's biased towards liquidity. So we have the problems related to may reject positive NPV investment. It requires arbitrary cutoff point, and it ignores the cash flows behind the arbitrary cutoff point. It's biased towards the long-term projects, means the once we are going to launch the new products and so on. So it gives us the inconclusive results. So you can use this example to make decision. Here arbitrary point is 2 years and the cash basic investment is 70,000 and we have 3 years cash flow. Then you can discount the first year cash flow, second year cash flow, third year cash flow. Then you can determine either you are getting back your money within 2 years based on the discounted cash inflows. Next is the average accounting return. So the average accounting return. So here we can use the information from the book value as well as the net income. So there are many different definitions of average accounting returns. So average net income divided by average book value, and then we have the note that the average book value depends on how the asset is going to be is depreciated. So need to have a target cutoff rate in payback period and discounted payback period. We need to have arbitrary date, arbitrary time period, arbitrary number. So here we need to have arbitrary rate, sorry. We need to have a cutoff rate. For example, I want to invest in a project if the required rate of return is 20%, and this is the required rate of return. That is the arbitrary cutoff point. And we need to find the rate of return based on the net income, average net income, and book value, and so on. So decision rule is accept the project if AAR means average accounting return is bigger than the arbitrary rate, means greater than the arbitrary rate. We accept the project, otherwise we reject the project. So we can accept or we can reject based on these rules. So computing ARR for a project, we have example, for example, 25% is the arbitrary rate, means the rate which is we are going to target. So the initial investment is 72,000 at the average net income. For example, we have the average net income of company ABC. So first year is 13,620. Second year is 3,300. Fourth year is 29,100. So there are 3 years net income. So we can take average. So if we have 3 years, so we can divide by 3. So the average value is 15,000. Average net income is 15,340. If there are 5 years net income, then we can divide by 5. So in this case, the average book value, average net income is 15,340. And how we can find the average accounting rate of return? Why accounting? We are taking the information from the books, from the cash flows, from the books. So to calculate average accounting return, we are taking the required information from the books. We are not taking information from the market. We are not taking information from the cash inflows, and we are not talking about we are going to forecast the project. We are going to select the project, but we are using the past data. So these books data, it's having severe problem, serious problem, this criteria. So in this case, how we can find the average accounting return? Average net income divided by outflow, means your basic investment is 72,000. Average net income is 15,350. So we are getting the answer, which is 0.213, means 21.3%. By using this information, by using this data, the average accounting value is 21.3%, but the arbitrary rate is 25%. So if we have the arbitrary rate 25%, it is greater than the average accounting rate. But the decision rule is suggesting if AAR, average accounting return, is greater than average accounting return is greater than the given rate, means arbitrary rate, the cutoff rate. So then we accept the project, otherwise we reject the project. So in this case, what are the advantages? What are the disadvantages? advantages are it's easy to calculate the information which we are required, the needed information, the information which can be used to calculate this criteria is normally available with the firm, so easily available to access the information. So what are the disadvantages? So it's not a true measure of rate of return because it's ignoring time value of money. If time value of money is not there, there is no risk adjustment. Will be no discount rate. It also use an arbitrary cutoff rate. So this is the this criteria is based on the accounting information, accounting net income and book value information. It's not incorporating. It's not talking about the cash flows and market information. It's the book information, not from the market information. So it's a weak way to find the to determine the to select the project for your investment. So you can find by yourself the net income for first year is 17,000, then we have 9,000, then we have 23,000. We can add them and we can divide by 3. We can find the average net income. Then we have the total basic investment, which is 99,000, and the accounting rate of return AAR is 8%. If the AAR is sorry, the cutoff point is 8%. Cutoff rate is 8%. If you can find ARR, average net income divided by basic investment, so then if ARR is greater than 8%, we accept the project. Otherwise, it may be rejected. Then we have the profitability index. What is profitability index? It gives us the information about the each unit cost and benefit. So it's more close to time NPV. It's if more close to NPV, it means it's dealing with time value of money. It's if time value of money, there is discount rate of return, that is the adjustment of risk. So it's also giving us the proper information of value addition, clear information of value addition. So measures the benefit per unit cost based on the time value of money. So the profitability index, for example, we have a project, it's giving us the ratio 1.1. What does it mean? Cost is 1 unit, but the revenue is 1.1. It means if our ratio is more than 1, it means there is a value addition. Cost is 1 unit, but the revenue is 1.1. So the revenue is more than cost. It means it's giving the value addition. It's providing us the information of value addition. Implies that for every $1 of investment, we can generate $0.1 extra, that is value addition. This measure is very useful in situation of if we have limited capital, if we have not sufficient financing for our investment, if we have a limited investment for limited capital for investment. So we normally go for the cost benefit analysis related to each unit. So how we can compute? We normally find the present value of all cash inflows divided by initial investment. Okay, present value of net cash flows divided by initial outflow. So here already we have done the same calculation of the in NPV. So we determine the present value of all cash inflows and we have the cash outflows. So after simplifying at the rate of 12%, so the basic investment is 165 and first year cash inflow is 63, second is 70,000 something, and third is 91. So first we need to find the present value of these all cash flows at the rate of 12%. Then we can present value, here is the cash outflow, the present value of all inflows divided by cash outflow. We can determine the profitability index if its ratio, if this ratio is more than 1 is then there is a proper value addition, that is the profit on each unit. Then we accept the project, otherwise we reject the project. So here is the, I'm sorry. So 63,120 divided by 1.12 risk per 1 means the present value, discounted value of first cash flow, second cash flow present value, third cash flow present value, whole divided by cash outflow. Again, this minus is just giving us the understanding it's outflow. So you're not supposed to put minus sign in the calculation, during calculation. Few students do, they are the genius, they normally put the minus sign here. So minus is just for our understanding, differentiating. So it's outflow and inflow. So after dealing with it, we are getting the ratio that is 1.07. It means if 1 unit is cost, then the revenue is 1.07. This $0.07 extra is the this 0.7 is the extra, means this is the value addition. So if the ratio is more than 1, we accept the project, otherwise we reject the project. So it incorporated time value of money. If time value of money, there is a discount rate incorporation. So this is also adjustment of risk, and it's providing the clear picture of, clear information of value addition. So if we have the clear understanding, clear information of value addition, we accept the that criteria is considered the best criteria. So in so far we discussed 6 criteria. NPV is following the characteristics of best criteria. So we have discussed 6 techniques. NPV is meeting the requirement of best decision criteria. Profitability index is also meeting the requirement of good criteria, means time value of money, adjustment of risk factor, as well as there should be value addition. So these are very close to each other, and IRR is also adjusting time value of money, but not giving us any information about value addition. Payback period, no time value of money, no information, but discounted payback period is incorporating time value of money, but that has its own problems. And accounting, average accounting measure return is having serious drawbacks because it's calculated based on the book value, means accounting based information, not from the market based or cash flow based information. So here you can go through for the practice. So the investment is 363. We have different cash flows. Just find the present value of cash flows at 8%. Then you have to find the ratio. If answer is more than 1, accept the project. Otherwise, reject the project. So here is the overall advantages and disadvantages of profitability index. It's closely related to NPV. It means generally leading to the identical decision, means both are having the giving us the information, clear information with value addition. So easy to understand and communicate, may be useful once we have the limited capital, we have the very less capital available for investment. What can be the disadvantage? What is the drawback of this limitation of this criteria? So the limitation of this criteria is it's not giving us the reliable results if there are mutually exclusive projects. If there are mutually exclusive projects, the project which are totally different to each other, then this profitability index is not working. It's giving the biased results. So this is about the profitability index. So capital budgeting in practice, we should consider the several investment criteria when making decision. So we normally prefer NPV IRR, the most primary investment criteria, and the second most used is the payback period, but it's not adjusting the time value of money. Here is a summary of each criteria of discounted cash flow criteria, which are discounted base measures. In the start, I discussed they are divided in 2 categories. One is discounted cash flows, discounted base measure. The other one is non-discounted. So the discounted base measures, is NPV. So definition of NPV is difference between market value and cost. It means the difference between cash outflow and present value of cash inflow. So what is DCN? So the DCN is take the project if we have positive value, and what are the problems, and it has not any serious problem, and it's the preferred decision criteria once you are going for selecting a project long-term investment. So the other is the internal rate of return, IRR. So it's adjusting what is IRR, the rate where NPV is equal to 0. How to calculate? Trial and error method can be used, already explained, go through it. So then take the project if IRR is greater than the required rate of return, otherwise reject the project. So NPV, IRR give the same results other than two conditions, means non-conventional cash flows and are mutually exclusive projects. Then IRR mislead, and they will give the opposite results. NPV and IRR will give the opposite results. So IRR is not reliable in two conditions, non-conventional cash flows and mutually exclusive projects. The other discounted base criteria is, so discounted base measures, the third one is the profitability index. It's the cost benefit analysis. So DCNS, if ratio is more than 1, we accept the project. Okay, it's what's its limitation? If there are mutually exclusive projects, then this criteria will not work. So it will give the different results. Maybe used to rank the projects if we have limited capital. Okay, so in the presence of limited capital, we can use this criteria. So these are the summary of payback criteria. What are these payback? Payback, the definition is how much time it will take or how long it will take to receive back money. Length of time until the initial investment is not recovered. So take the project if it's paying back within the given time period, So don't account it doesn't account the time value of money, and it has arbitrary time period. So these are the problems, drawbacks of this criteria. Discounted payback period, it's adjusted time value of money. It's also having the same definition, how much time it will take to receive back your money based on the discounted cash inflows. So initial investment is recovered on a discounted basis cash inflows. Take the project if it's going to be paid back within a specific time period, and it also needs an arbitrary cutoff date. So this is the drawback of this criteria. Then we have the average accounting return. So average accounting return, it is based on the accounting information. So measure of accounting profit relative to the book value. So like return on assets measures. So take the investment if AR is greater than the arbitrary rate. So if it's greater than the arbitrary rate, how we measure? So the average net income divided by total outflow, then we can measure if this AAR is greater than the arbitrary rate, means the given rate, then we accept the project. Otherwise, we reject the project. And this criteria is having several problems, severe problems. So it's ignored time value of money. It's the information is not taken from the market. This criteria is utilizing the information which is taken from the book. So this is the summary of these all criteria in last 3 slides I discussed. Here is a practice question, and this single question can give you the overview of all criteria, else AAR. So for example, the question is 100,000 is basic investment, and every year you will be getting 5,000 for next 5 years. So it means you can find the present value of these cash flows by using annuity, means series of equal payment. Every year you are getting 25,000. If 25,000 you are getting every year, it means more than one payments, and these payments are equal. It means this is series of equal payment. If it's series of equal payment, then we can name it annuity. So if it's annuity, so we can go for the annuity interest factor table. So you can find the present value interest factor table at 9% is the required rate of return for 5 years. Then you can multiply with 25,000. If the value of this cash inflows, present value of this cash inflows at 9% is greater than 100,000, then we accept the project. Otherwise, you can reject the project. So to make the decision for payback period or discounted payback period, we have 4 years. So you can 100,000 minus 25. Then we left 75,000. Then 75,000 minus 25, and so on. You can find the payback period, and then you can go for the discounted payback period. So these are the criteria. So you can find NPV, you can find payback period, you can find discounted payback period. Either you accept the project or reject the project. Find IRR and NPV, profitability index, and make decision which criteria is leading you to accept the project and which is recommending you to reject the project. So this was all about capital budgeting techniques topic. So hope this lecture will help you to understand the overall concept, its basic, and how we calculate the values, how we measure. So I wish you the best of luck. So